Howdy, Jacob here. Today we're looking at the next company in our dividend yield screener, Euroseas. So I'll start looking at some financials here. So first thing, 7.15% dividend yield, $194 million market cap with a $254 million enterprise value. So a little bit of net debt, but not substantial. It looks like pre-COVID, they made negative earnings for the previous 8 years, and then COVID happened, and then 58 cents a share, $6 a share, $14.78 a share, with massive returns on invested capital. So they transport containers of dry and refrigerated manufactured products and perishables. Doesn't look like there was any change from acquisition or anything. Their dividend pays out $14 million, which for the last 3 years looks manageable. But again, cash flow from a cash flow standpoint, weren't really making any money prior. I guess it's weird here too on the revenue side. Fairly consistent, 30 to 50 million maybe, and then jumped up all the way to $183 million revenue in a single year. Their shares also jumped fairly substantially. A 1.7 PE as of right now. And then a zero point 0.8 price to book. Let's see on their balance sheet how it looks. Capital intensive, 276, not necessarily capital intensive, but a capital heavy business, 276 million on property, plant, and equipment, 47 in current assets, long-term debt of 52, short-term debt 55. Again, in comparison to recent years, all these numbers look absolutely fantastic. It's really just whether they can hold the business steady with the figures that they are currently showing. So let's get to some assumption setting. Again, businesses that have gone up so fast so recently, I presume that they might go down in the near term and then back up over a 7-year period. So I might assume 0% and then 10 on the PE, given the fact that they're by that time a not growing business, which seems weird, obviously, after looking at the last 6 years and them growing 15%, upwards of 94% year over year. But with that fast growth, I just don't see that necessarily being sustained. And again, it's not due to any acquisition, it appears. So for me, I'm assuming that there's a 0% increase on revenue growth in a 10p, 15% discount rate. Again, so weird with margins here. I'm just going to do a huge range. Share change, maybe 0%. Yeah, so down 16%. That's assuming the $2 a share stays at the 14 million payout that they're having, which for the recent couple years looks reasonable. But I'm actually glad to look into this stock soon to see whether I think that these margins are sustainable or not. But yeah, I think initially it was a positive first review. Just has to drop 16% to get a 50% discount rate. So for me, I'm just waiting a little bit before I do some more research on it and seeing whether it's truly a good buy or not. Companies that are so different in the most recent years, or if there's a company that you just don't have a lot of data on, it's tough to come up with initial assumptions without really digging into the company. But this looks like something I want to dig into soon. So thank you, and hope you have a good rest of your day.